Hello and welcome back to another episode of the Blue is the New White podcast. All right, guys, buckle up because today we have a true game changer on the show. And when I say game changer, I mean this company is on course to alter the skilled trades landscape and the future of the middle class forever. Menees, CEO of Fynn Credit, joins us today to talk about how their creative financing solutions are enabling more students to attend trade school and be placed with permanent employment. Eric has quite the resume himself as a reformed researcher, as he put it, in several fields I can barely pronounce. He's always had a deep appreciation for the skilled trades, with several of his friends and family pursuing these important careers. Once he had a firm idea of the problems that existed in these industries and what was leading to this skilled trades gap, he was able to craft an incredible and tangible solution which benefits employers, educational institutions, and the workforce of tomorrow. You're not going to want to miss this one, guys, so buckle up, sit down, tune in, and pay attention. Don't forget to subscribe to this channel and on our website at blueisthenewwhite.com to receive all the latest updates. You can now find this podcast on iHeartRadio, SiriusXM, and Pandora. As always, we rely on word of mouth from our listeners to further the mission. So if you enjoy this episode, please do me a favor. Take a second to rate it, review it, and share it with your friends. The future generations of tradespeople depend on it. They depend on you. So thank you again and enjoy this episode of Blue is the New White with Menees. Hello and welcome back to another episode of the Blue is the New White podcast. I am super excited about our guest today. We talk to people in the trades all the time. We talk to people who are advocates of the trades all the time, but we don't often get an opportunity to talk to those who serve the trades quite like Menees. Eric, welcome to the Blue is the New White podcast, my friend.
Happy to be here. Thanks for having me on. I appreciate it.
Yeah, absolutely, man. I'm excited for this conversation. I think my audience is going to find a ton of value, and I'm just excited to learn more about you. So to that vein, can you kind of explain, introduce, tell us who you are, where you came from, and how you got to where you are today?
Happy to. Yeah. So I'm Eric. I grew up in the Houston area, which is going to be relevant shortly. My mom was a dental assistant, dental hygienist, so working in the healthcare trades. I had some family members who worked in construction in various capacities. And in general, just a lot of tinkerers, builders, fidgeters, if you want to put it that way, in my family growing up. So I've kind of been the same way. I did a lot of robotics on myself, a lot of DIY projects kind of growing up. Really kind of fell in love with technology. Ended up pursuing a few degrees in mechanical engineering, biochemistry, and neuroscience at University of Texas in Austin. Did a lot of research with robotics, with NASA, did brain implants with DARPA, really just fell in love with tinkering at the highest level.
Okay, well, let's be careful what you say on the show, because I don't want one of those, if I told you I'd have to kill you situations, that's not good for my audience.
Don't worry. I'll be very careful. You do a great thing. I don't want you to have to end it prematurely.
Thank you.
But, so I went really deep in the research track, but I realized pretty quickly that I was doing one thing in particular that other people in the lab weren't doing. I was the guy who every time was conveying why what we did mattered, right? Mm-hmm. Why what we did related to the rest of the world. I eventually, kind of dug in there and said, maybe this is a skill set I should nourish, because I seem to really enjoy it. It seems to be something that's valuable to the places I'm in and I'm working at. Helped this professor spin off a startup out of one of the robotics labs we were in. We were selling actuators and motors to Lockheed Martin, Boeing, exoskeleton companies around the world, and realized I loved entrepreneurship. I liked research. Don't get me wrong, but I kind of run up against the limits of really begging for government funding, trying to find sources of cash where this don't exist, being limited in the research mandates you could do based on where the funding was actually available in the first place. And I found entrepreneurship was just more free and immediate. You could actually have a change today as opposed to 40 years from now once your tech finally gets commercialized.
Yeah.
And that just meant a lot to me. So I went into entrepreneurship, kind of pivoted my whole career. I'm a reformed researcher, I like to say, and started working on my own companies. So that was my path. The specific thing we're working on here with Fynn Credit in the trade space is directly because of my upbringing in Houston, my parents and family members working in the trades, and a lot of my good friends going through various trade programs to become welders, HVAC technicians, mechanics, etc., and seeing some of the challenges they face and wanting to work on those.
Awesome. Well, we're going to get into what all that means with Fynn Credit in a minute, but I am curious, what is it? I mean, I know you said that you were kind of surrounded by people who were in the trades, and by the way, I don't know if you've gotten a chance to pick up my book at all, but dental hygienist, I actually list in there as a skilled trade, because my definition of a skilled trade isn't necessarily that of a blue collar one, although that's what people gravitate towards, but really it's anything that requires formal education that isn't college. And
exactly,
so I like to cast that wide net. So I just wanted to point that out. But my actual question is, what is it about these industries that you value so much? What is it about the skilled trades, or even the blue collar skilled trades, or why does it mean something to you?
Great question. For one, I've got to be thankful because I'm here because of it. We wouldn't be talking possibly if it wasn't supported. My family wasn't supported by trade work.
Sure.
On the other end, I've seen firsthand, both within my family, with my friend group, just how impactful these jobs are for everyday Americans, especially for younger Americans who are still finding their footing in the world, who are still trying to figure out how to make that jump from, like a lot of my friends were, lower, economic position into the middle class. How do you go from that part-time food service job to a stable career where you can really build value and make money to afford yourself and your new family and your lifestyle? And trades are the best way I've seen to do that.
Yeah.
They're completely overlooked. It's from a country standpoint, and not to the point that students don't know about them, but to the point that they can't afford them because there's not infrastructure built for it, which is kind of where we come in.
Yeah, that's a really good point. I mean, we all know, and I talk a lot about this show, that there's a few different paths into the trades, and it all depends on the trade, right? There's thousands of them out there. People don't realize how many trades exist, and there's different barriers of entry to each one, right? And oftentimes it's a monetary value, like trade school, for instance, HVAC, refrigeration, stuff like that. That costs money. You can go the apprenticeship route, but I say often on this show, I started in the field. I was in the field for 10 years as a technician, right? And I don't have a lick of trade school under my belt, but if I had, I probably would have advanced a lot quicker than I did, just because of the fundamentals and everything that you gain from it. So to that point, then, how is Fynn Credit helping with people to get into, how does Fynn Credit help?
Yeah. So what Fynn does is it solves a specific problem we've identified with schools across the country, these trade schools themselves, that goes down to the students and goes up to the employers, which is, you talk to any school and they say, we've got an abundance of students wanting to attend our program. We've got 100 seats for this cycle. We've got 200, 300 kids applying. However, we're only seeing 30 or 40 in the classroom. Something's wrong. And when you dig into that, every time it's the student sitting down with the school saying, I'm so excited to become a welder. I'm so excited to become an HVAC technician. I'm so excited to become a nurse or a dental hygienist. How can I pay for it? And the schools every time are like, well, what's your credit score? And a lot of the students are like, I don't have one, or not that good yet. And that right there is the end of the conversation, because I was very surprised to learn this. Federal aid, for example, that serves students at traditional four-year and public universities doesn't reach down to more than 30% of schools in this post-secondary training space. And even where it does reach down, it doesn't always cover the whole tuition. So you think about like a 10K, average tuition here. A student who is working part-time food service, who comes from a lower economic background, whose family doesn't have generational wealth, right? That student, even if 8K of that 10 is covered, still probably can't attend, because 2K is too much. And so this system that was built for higher education isn't working here, and it isn't servicing the people that it should be. And you look at the private markets aren't that much better. There aren't a ton of players in the space compared to the four-year public education space. And the ones that do play aren't really thinking about or built for this, 60+% of students who look like this, right? Who have this demographic, this background, who are maybe young, new to credit, haven't built that out. And so it's hard to underwrite them.
Yeah.
And so you have this massive amount of people that want to go into the trades, but are struggling to figure out where to get the capital from. And so we have built an underwriting stack and a financing product to partner with those schools to be able to solve that for them.
Wow. Okay. So you partner with the schools themselves, and the schools offer the students your product. Is that right?
Exactly.
Okay. And how many schools are you? I mean, I know that, well, let me ask this first. How long has Fynn Credit been around?
We have been around officially since 2019. We really launched in 2020, the beginning of 2020. We went through a startup accelerator called Y Combinator in San Francisco, which was wonderful and extremely helpful to find investors that really care about this mission. And ever since then, we've been able to put about $10 million to work so far, helping students attend programs. We're scaling it up to 25 by the end of the year. We'll have out the door into students' hands. And we're working to bring that to 100 million next year.
Wow. That's amazing. So how many schools, I mean, I don't know your KPIs or your measurements of,
Sure.
But how many schools are you in? Or if I'm asking a question that you have a better answer to, feel free to give me.
Totally. I think about it on a program basis because you can have lots or few programs per school.
Okay.
We've got, let me actually check our dashboard right here. We have 270 different programs live right now.
270 programs. And what's the difference between programs? You said you could have multiple programs per school. What does that mean?
So let's say there's a school that trains for truck driving and diesel mechanics, for example. We'd have a trucking program and a diesel program. Or you've got a school that has different classifications of welding programs or different, a pipe welder versus something else. There's lots of different levels and even just different types of options, especially as you go bigger in the schools and they start to become more inclusive and comprehensive. And it starts to look maybe more like a community college in a sense. So I think about it on programs because I care about, are these programs leading students into good outcomes? And if so, that's a tick.
Wow. Okay. That's great. That makes a lot of sense. So, sorry, I'm trying to wrap my head around all this. This is really cool.
Oh, thanks. I appreciate it.
No, yeah, that's all I got. No, I'm just I'm just kidding.
No.
So basically you can think of a program as a trade, right? You have one program per trade or per course or something like that per offering of the school.
Yeah, I think about it that way, where it's like, if it's a welding school and all they do is welding, they might have different programs depending on what level of certification or direction in the industry. And then if you have a more generalist school, they might just have a few different types of programs, like a medical assisting program, a dental hygienist program, a CNA program.
Okay. I got it.
But each of those are different career paths, right? So yeah. I like to count it on a program basis because I think of the actual individuals going through.
And so typically, for typical loans and underwriting and stuff like that, I mean, there's a lot of risk management involved. What enables you guys to be able to provide this type of funding and still, secure enough to be called a business, right?
Exactly. Now that's the question. We started thinking about the problem differently. So a traditional lender, right, will, especially just coming into the space opportunistically, which is, how I like to think about it, coming in, taking the underwriting model that works at 4 universities and pivoting it to this space without regard for the demographic. All they're saying is, what's your credit score? Are you a 750? Awesome. Here's an offer. Most students in this space, right? And I'm simplifying it, but yeah. that's kind of the by and large of it. Most students in this space don't look like that, right? Maybe whether it's a 44-year-old who is trying to start a new career after a lifetime in a different career and wanting to get into space and maybe has had some financial hardship, but they're not a bad borrower by any means, but they just don't have strong credit. Or it's an 18-year-old coming out of high school in like rural Alabama And like I already mentioned, they don't have that generational wealth, and they don't have the ability to build savings in their current job. And they haven't started, they haven't even opened a bank account half the time is what we're seeing in half of our applicants.
Yeah.
That doesn't even match the traditional underwriting stack.
No.
So what we do is we said, okay, what data do we have? Well, we know that there is a hell of a lot of job demand in the trades, independent of kind of where you look, right? Yeah, you get it.
I see where you're going.
We start top down instead of bottom up, right? So we look at the trades, we say, okay, independent of the school, independent of the student, what trades have a really big supply and demand mismatch such that any student that goes to one of these programs and graduates is probably going to get employed because they just need workers in that space, right? So we look at that. We look at things like the churn rate out of the industry, which, no surprise, is very, very low, because who wants to go back to, Wendy's or McDonald's or part-time food service when you now have this amazing, incredible, fulfilling job. And we look at, salary to tuition ratio, making sure that the salary growth rate is going to be sufficient to justify, going to the programs in the first place and actually support you in your career. We look at a lot of things like that. And when we get comfortable to the point that, okay, yes, any student that came out, we believe 9.9 times out of 10 is going to get into that career and stay into that career, that's great for us as a lending partner. So we move down the rung and we say, okay, what schools are good at training for that, right? And the beauty here, as opposed to just like coding boot camps that have spun up overnight, no hate on coding in general, but they have a shorter track record. These schools that we partner with have been around for a lot longer on average, 5, 10, 15 years of proven performance, right? This is stuff that we've been doing for a long time, welding and truck driving, et cetera. So we can actually look at that performance and we can audit it and say, wow, that's an 85% grad rate. That's a 93% placement rate within 6 months. That's reliable. That's some of our error bars right there. And so by the time we get to the student, it's a lot of pressure off of them and the fact that they may or may not have credit, right? We can be more holistic with being able to go deeper and serve the majority of the students in the market.
Wow, this is incredible. What a great way to look at this, because you're essentially leveraging the gap. You're essentially leveraging the gap to fix the gap.
Exactly.
What the heck?
Exactly.
Okay, that's
why punish people just because they don't have a specific number on a sheet of paper when there's all this other data supporting it.
Yeah, that's amazing. I think that's a wonderful way to look at it. So a couple questions from this. So how do you partner? Okay, no. Mm-hmm. I've got a lot of questions. Hold on. Hold on.
No worries.
How do you make money?
Yes. A few ways. Obviously, we are a lender, so there is a loan at the end of the pipeline. No surprises there.
Right.
Our goal, though, as a lender is to partner with other players in the space, namely the schools and the employers, to drive the cost of education down for the student over time. We're just starting out now, so we're, pretty market comparable with other people in the space, but we're already starting to be able to get better economics with the different players, and we're starting to work with employer partners on eventually what will become fully backed programs where the student gets a free education and a guaranteed job, and it's fully covered through a process of cash from the other players. So it's essentially, if I can put it another way, we make money without putting too much burden on the individual by spreading the risk to institutional partners. Okay.
All right.
I don't know if that was comprehensive enough, but yeah.
No. That's okay. Cause it's going to lead into my next questions. So then how do you engage the employer? Mm-hmm. What's their role in this?
Yeah. So that's a great question, and something we're actually actively doing right now. So if I can take a step back, we just launched a job support and career success team internally, which is working with our students, with our borrowers. This is something that no other lender in the world will ever do. Most other people are just like shotgunning money out and then closing their eyes and hoping that it comes back to them in the future. Is how I look at traditional underwriting. What we do is we actually work with our members on resume help, on how to run a job process and job search process. We just placed our first borrower doing this last week. And we're also reaching out on the other end to employers and saying, we've got candidates that you probably really need to fill jobs with. This is all manual right now. It's all MVP kind of stuff. We're doing it we got a person running it on the student side and a person running on the employer side, but we're going to build out technology around that to expedite this process. And a little peek at the next page of the book is we're going to probably get into some staffing stuff there where we can actually help students who, are going into careers where you need 3 months or 6 months of work before you actually get hired full time by a company. Work with us. We'll help you get that experience so that you can then go land that full job, because we care about the outcomes, unlike most other people in finance.
Yeah. And it also serves as a guarantee for the actual product.
Exactly. Exactly. It is. The whole message here is aligning incentives.
Yes.
If we can align incentives and everybody wins, why wouldn't we do that?
That's what I'm starting to pick up is everybody wins. And it's gonna lead in my next question a little bit, because it's all inclusive. But how do you engage then the schools? How do you approach them? How do you partner them? I can probably by this point take a guess as to what the incentive is for them, and how easy of a pitch that could possibly be, for those who understand it. And if I'm gaining an understanding in 20 minutes on a podcast, I'm sure that they can too. But I want to answer your question for you. So how do you engage or partner with the schools?
Great question. One, we have an amazing sales team, so shout out to them if they're listening to this. We've got people who have done this before, who've literally been owners and operators in the trade space, who know how to talk to these schools and understand their pains and their problems really well. So that's the first part. Second, they have a Rolodex of people across the country that they know that have this issue. But really, candidly, all trade schools have this issue. So when we talk to them, it's not hey, we need to convince you that this is a problem you need to solve. It's more of oh my God, thank God you're solving this. Because the number one hair on fire for schools is figuring out how to get more students in the seats. So when we talk to them, it's literally just calling up the schools, canvassing them, running a traditional sales funnel. But the sell is incredibly easy because we both need it. Yeah. We need to help the students and they need to get them in.
And at the end of the day, does it cost the schools anything?
It depends. Okay. Most lenders will put, depends on, it does, but it depends on how you are thinking about it. Most lenders will put some sort of like risk share structure on the back end. Okay. Basically, so the school has skin in the game, which we found a better way to do, I believe. A lot of that risk share structure is, based on a year or 2 year performance of the actual loans and the actual students, which the school can't really affect, right? The schools, sure. That's not what they do. They train really well, and then they move on to the next batch of students. So we figured a way to tie those risk shares to actual outcomes the school can affect, like graduation and placement into a job. And so they'll actually, be able to realize that risk share that's normally just held in like an escrow account in a traditional structure for years within like 6 months of graduation. So we find schools love that. And again, it's aligning incentives, right? We don't want the school to not care about the students' outcomes. We want them to care immensely, just like we do. And I'm not saying they don't, they definitely do. Like, these are good schools we're partnering with. It's just another example of how we're kind of aligning all of those pieces. Wow.
That is, this is an incredible concept, Eric.
I appreciate that.
So we spent a lot of time
getting into the nitty gritty here.
Yeah.
I mean, even down to the loan product itself, and like how we, forgive interest with some of our member benefits, which is something we haven't talked about, just so it doesn't affect a student's tax burden improperly. Like, very small stuff that typically no one looks at.
Wow. Can we get into that a little bit?
Sure. Absolutely.
Yeah. I'd like to just know more.
Yeah. So, on average, we're looking at, let me say this.
Sure.
When we first kind of entered the market, this market doesn't look like a 4-year lending market. You can get into why it doesn't look like a 4-year lending market all day. My opinion is that in the traditional lending space, you just like with 2008 and the housing crisis, people just keep rating these loans as good and keep extending the term of the repayment length another 30 years. So the bubble hasn't kind of popped. And that's why you have good performance and low defaults on them. But that's an opinion, right? So that's my opinion. In the trade space, it's well accepted that you're going to have higher deviance, right? it's just it's a different market. That's the way to put it. It's a different market. But we built for that. We didn't just say, oh, well. We were like, okay, well, how can we set it up so that people can have the best chance of success in the outcomes? We built in a few key product features into our loan that are very not off the shelf. So, for example, I already told you about our underwriting stack, how we look at, the outcomes first before we even get to the school of the student. Let's say we were wrong, right? Because we use that ultimately to help price how much someone's going to be paying back on a monthly basis, right? Let's say we were wrong because we want it to be affordable. And if it's not affordable, no one's going to be able to pay it. Like, people make all these theories about why people don't pay back on stuff. Plain and simple, they don't pay back if they don't have the money.
Yeah.
Like, I get it. I had a lot of student loan debt. I completely understand it. So if we're wrong on the salary that we expect someone to make out the gate, we should change with it. And so we do what's called payment reduction in the case we were wrong, up to 20% reduction in perpetuity, as long as that is still wrong from our calculations, that the student doesn't have to pay back on the loan on a monthly basis. And that's huge. Like, that's not something other lenders really do. Other lenders will just like pause you or put you into default. Like, it's horrible. There's no working with the student and understanding that life happens, which kind of leads into our second thing. And actually taking a step back, that's where I was talking about the way we actually process that is student conscious. They don't have to like get a W-2 and all this tax stuff at the end of the year. Which again, I just props to our legal team. But the next thing is like, okay, let's say life happens. Like I said, we let people pause their payments on a 3-month basis up to a year with no interest accrued, because we want to be that partner in your success, right? I understand what it's like to be on the other end of the table, right? Got in a car accident, like, had to figure out which bills you have to pay first. Like, that stuff happens. But normally you're penalized for it or not allowed to do anything about it. And then what's that going to do? It's just going to screw the person over, and they're going to ghost. So we built that out. And the last is, if it's been, say 15 years, which is the maximum timeline of that we put on these products, and you still haven't paid it off, we just wipe the whole balance. Because this should not be something that haunts you for the rest of your life. This shouldn't be something that you're worried about later on into life. If you've spent 15 years really trying and working with us to help pay us back, we'll forgive it at that point.
What?
Yeah.
That's awesome. And that's obviously there's prerequisites there. Obviously, they have to show, adequate payment history and stuff like that. I'm sure.
Yeah. Like, you're trying to get a job, stuff like that. You're actually like applying. Like, it's not just like call us in 15 years.
Yeah. It's not just like, of course let's try not to pay as much as we can for 15 years and then they'll forgive it. Right.
No, exactly. It's just, we really want to be conscious of the fact that that's a long period of time.
Yeah.
And if you've been struggling and working and it just hasn't happened because that's the way life is, you're done. You're good. And
I imagine, and correct me if I'm wrong here, and I'm just presuming because clearly I'm drinking from a fire hose here, but but I'm presuming that the smaller loan amount, right? And when I say smaller, it's I'm assuming you do loans like 20,000, 15,000, 10,000,
10K on average.
10K on average. So that actually works to your benefit in something like this as well, in being able to forgive after 15 years.
Exactly.
Yeah, and so
it's not a huge hit.
It's not $100,000 student loan or $200,000 student loan.
Exactly.
Okay.
Because of the market, because of the industry, we're able to do a lot of these like friendlier, more human kind of features.
That's the key right there. More human. Yep. I love it, man.
Mm-hmm.
Dude, that's awesome. This is great. So what aren't I asking?
It's a good question. I guess one of the things I love to talk about is, where I think we could go with this.
Yeah.
I think one of the answers, there's quite a lot of white space here. I mentioned this earlier. One of the interesting statistics that we've seen is at least 50% of all the people that apply to us have never opened a bank account before. Like, financial literacy is a huge issue. We work really closely. We have a series of meetings with our customer service and support teams with people at the beginning, middle, and even after they've graduated, just to make sure they really get what's going on and they really understand what the obligations are, how we can help them, stuff like that. I want to do more there. I want to do more. I think there's a lot of opportunities for, just because you got into this amazing trade, you're on your path to six figures, overnight that happening doesn't mean JP Morgan is going to look at you any differently because your credit score is still non-existent.
Yeah.
So I think there's an interesting opportunity for us to be able to, having already been a trusted financial partner for the first time in a lot of people's lives, offer them additional things that they're just not going to get otherwise for a while.
Yeah.
Whether that's, I don't know what that looks like yet, whether that's a banking account, personal consumer loans, a car loan, a mortgage, like that's very interesting to me. How can we build out tools and services that should be offered to them but aren't?
Yeah, especially since you're building the infrastructure right now. There's no telling where what you're going to find once you start collecting data from what this infrastructure does.
Exactly. The data is huge too. I mean, nobody has built a model on this kind of like subprime group because there's just nothing to do there. But we're going to be able to actually utilize that for good to provide products and services and opportunities that are usually denied to this type of borrower.
Yeah.
Which I think is cool. And then the other thing that we're looking at is more of that employer stuff. Can we spin up training programs, not necessarily our own school, but can we partner with schools to do custom training programs with some of these employers because they need them so badly? Yeah. I mean, Michelin, for example, they raised the requirement from 1 diesel mechanic per location to 2. They can barely get 1 still. So they're flying in people from Denmark to live and work in Wisconsin. It's nutty. And we should be able to help solve that. And in turn, provide more, cheaper or free education to students.
Wow. That is amazing. I didn't know what to expect when, before I talked to you, I didn't do a ton of research. I usually do, but I've been crazy busy out here. And holy crap, man, you're blowing my mind. And I know that my audience right now is like, oh my God, are you hearing this guy?
I appreciate it. Thank you.
Oh, that's really, it's great.
Yeah, we're trying our best out here. And I'd say the last thing, is within all of this problem is so big on a country level. Mm-hmm. We're facing the greatest skilled labor shortage since World War II. This isn't something that just one company solves. This is going to require, regulated involved in solving the problem. But that's something we're tackling.
Oh, there you are.
I lost you for a second. Where'd I cut off?
Just for a second. Just after greatest shortage since World War II. Sorry about it.
No, all good. we're like I was saying, we're facing the greatest skilled labor shortage since World War II, and just one company isn't going to solve that fully. Right. We're going to do our best. Don't get me wrong, but this is going to take both sides of the aisle, government involvement, corporate involvement. Like that's really where we want to go with this. Yeah. We want to build this into a movement, really.
Oh, I love hearing that. No, that's fantastic. And this is something that this industry, listen, you're guest number 152 on this show. And, I've always talked about what we need to do for the industry, and because obviously that's the whole premise of what we talk about every week. And it just goes to show you don't know what you don't know, right? Because now I'm looking at this and what you're saying, and I'm like, holy crap, this is what we need that I had no idea we needed. And
that's where I was.
It makes perfect sense as you lay it out. I just never knew that there was a solution there. And that is super, super cool.
And there wasn't, and that was kind of why we started. When we started this business, to be honest, we thought the problem was kind of what the media was portraying at the time, which is people don't know about the jobs or think they're dirty or they don't pay well and stuff like that. And so we're like, oh, well, we'll help connect high schoolers with trade schools, a software portal, blah, 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 blah. we talked to 500 trade schools. It was abundantly clear that was not the issue. And it was really a financial capital markets kind of solution, which is hard. That's why it's taken us so long, since, the past 3 years.
Wow. All right, cool. Well, listen, I want to move to close here because I want to keep my listeners engaged. I do have one more question for you though that I like to ask everybody on the show. So in the book and on the podcast a lot, we talk about success, and what I like to say is that right now we live in a world where everybody tries to paint somebody else's picture of success, right? What that looks like,
yeah.
and it's hard because you ask an 18-year-old what success looks like. You asked me what success looked like when I was 18 years old. It was having the fastest car on the block, right, with underglow, and it changes, and it's not static, right? It's dynamic, and it's subjective to everybody. So that's a really long way of saying that the skilled trades can allow the opportunity to live how you want to live. And so I'd like to ask everybody, what's your definition of success, and how are the skilled trades helping you achieve that? So I'm asking you that right now, Eric.
That's a good question. My definition of success is very tied to what we're working on. I want somebody 20, 30, 40 years from now to write a book about how we helped rebuild the middle class. That for me means I've done my job. And I think that is intrinsically, inseparably tied to the skilled trades and the skilled labor. That's what keeps me going every day. Personally, I think that my definition of success is more never giving up, no matter what life throws at you. That's the number one thing that I've seen to be true out of everything for why I'm still here. But yeah, I hope that was a good answer for you.
That's a fantastic answer. I love that. No, I really appreciate this, Eric. I know you're a busy guy. I really, I just can't thank you enough for coming on the show and sharing your wisdom and your ideas and your product with, everybody that listens. So before we wrap it up for good, where can people find you? Where can people find Fynn Credit?
Yeah, so you can find Fynn at fyncredit.com. Depending on when you see this and when this goes out, we'll probably have a whole website revamp done. But yeah, Fynn Credit, FYNN credit.com.
Perfect. Eric, thank you so much for your time today and for coming on the show, man.
Thank you. This has been a pleasure. Talk again soon, hopefully.
All right. Take care, bud.